Picture this. It's September 2007. The CEO of Merrill Lynch, Stan O'Neill, summons a risk manager into his office. Now, this isn't just any risk manager. This is a guy O'Neill had basically exiled for asking too many tough questions. And O'Neill's heard a rumor. He's heard this man has a number, a single figure that represents all the losses brewing deep, deep inside the firm's mortgage business. And he needs to know what it is. The number? $6 billion. And the manager warns him it could be a lot worse. I mean, can you imagine? That was the moment. The exact moment a mid-level employee looked one of the most powerful men on Wall Street in the eye and told him the party was officially over. That single conversation, it was the very first tremor of an earthquake that was about to shake the entire global financial system to its very core.
Welcome, everyone, to Book Talk Finance. This is the show where we unpack the essential books that are really shaping our world. Today, we are diving deep into an absolute giant. All the Devils Are Here by Bethany McLean and Nocera. Now, if you've been following finance for a while, that name, Bethany McLean, should ring a bell. She's the incredible journalist who helped blow the lid off the Enron scandal. In this book, she and Nocera didn't just ask what happened in 2008, they went deeper. They uncovered how it happened, piece by painstaking piece. And you see, their book isn't really just about a crisis. It's about the creation of a machine. A vast, unbelievably complex, and for a long time, an astonishingly profitable money machine. And it was built over decades by some of the smartest people on Wall Street. So in this deep dive, we're going to follow their blueprint. We'll see how it was designed, what kind of fuel made it run, why nobody stepped in to stop it, and how in the end, it just completely, spectacularly blew up. So here's our roadmap for today. First, we'll see how this machine was even built in the first place. Then, we'll look at the fuel it was running on and explore why the regulators were basically missing in action. Finally, we're going to watch the whole volcano erupt and tackle the most crucial question of all. Why does this story still matter so much today? So let's jump right in. Part 2, building the money machine. You know, the gears of this financial engine were actually assembled long before the crisis ever hit, starting way back in the 1980s. This wasn't some grand conspiracy. It was a series of brilliant and, as it turns out, ultimately dangerous financial innovations, each one building on the one that came before it. You have to understand, before the 1980s, the mortgage market was a pretty sleepy local affair. A bank in your town made loans to local homebuyers, and that was it. They just held on to them. But this was super inefficient. You'd have money trapped in one region while another had a shortage. And for Wall Street, that kind of inefficiency just spells one thing: opportunity. The core innovation, the big idea that changed absolutely everything, was securitization. This was a concept really pioneered by a larger-than-life trader at Salomon Brothers named Lou Ranieri. And his big idea was to take thousands of illiquid things, like individual home mortgages, and bundle them all together into a single, liquid, tradable bond that you could buy and sell anywhere in the world. And the process itself was just revolutionary. So, step 1, lenders make the loans. Simple enough. Step 2, they turn around and sell thousands of those loans to Wall Street. Step 3, the banks bundle all of them up into these giant pools. And then step 4, the real magic. They sell off slices of these pools to investors all over the globe. Suddenly, your mortgage in Peoria, Illinois, could end up inside a pension fund in Norway. It was wild. And the growth? It was absolutely explosive. What started out as this kind of niche idea grew from about $350 billion in 1981 to a staggering $3.3 trillion market by the end of 2001. A fire hose of global capital was suddenly aimed directly at the American housing market. Now, this new market had two competing superpowers. On one side, you had Wall Street. They wanted a purely private market, driven by one thing: maximum profit. But on the other side, you had the government-sponsored giants, Fannie Mae and Freddie Mac. And they had this really conflicting mission. They had to make money for their shareholders, but they also had a public mandate to promote home ownership. This tension would define the market for decades to come. Okay, so the next critical piece of the machine, invented over at JP Morgan in the mid-90s, was the credit default swap. Just think of it like an insurance policy on a bond. But this little innovation did something crazy. It separated the risk of the bond from the bond itself. And here's the wild part. You didn't even have to own the bond to buy insurance on it, to bet on its failure. This thing became a tool for massive, completely unregulated speculation. So by the time we hit the 21st century, All the pieces were there. Securitization could turn any loan into a tradable bond. Credit default swaps could slice and dice the risk any way you wanted. The machine was a marvel of financial engineering. It was ready to run. But it needed a new high-octane fuel to really, truly take off. Which brings us to Section 3, fueling the fire. So in the early 2000s, right after the dot-com bust and 9/11, the Federal Reserve slashed interest rates down to historic lows. This created a flood of money desperately searching for higher returns. And Wall Street found the perfect source, subprime mortgages. These were loans made to borrowers with, let's say, less than perfect credit. And right here, this is where the entire business model just completely flipped on its head. See, banks used to originate to hold their loans. It means they made a loan and they kept it. And because they kept it, you better believe they cared if you could pay it back. But the new model was called originate to distribute. Mortgage companies made loans with one and only one purpose, to sell them off to Wall Street as fast as humanly possible. The risk, not their problem anymore. And that severed the link to responsibility. The only incentive left was pure volume. And just look at this explosion. The subprime market went from being this tiny little corner of the financial world to an absolute juggernaut. We're talking from $35 billion in '94 to over $600 billion in 2005. This wasn't just growth, it was a full-blown mania. This was the high-octane, highly volatile fuel that the machine was absolutely craving. To really understand this boom, you gotta know the people who drove it. And first up is Angelo Mazzillo of Countrywide Financial. He was the son of a Bronx butcher, and he built America's largest mortgage lender, driven by this powerful desire to democratize homeownership, but also by a really deep-seated resentment of the Wall Street elite. And this quote, it really says it all. Mazzillo saw himself as an outsider, right? An underdog fighting the establishment, and he desperately wanted to beat them at their own game. This ambition, this resentment, it fueled Countrywide's relentless, almost obsessive push for market share, driving it deeper and deeper into the riskiest subprime loans just to keep that growth machine going. And then there was Roland Arnold, the founder of AmeriQuest. Now, unlike the very public Angelo Mazzillo, Arnold was intensely secretive. He was a Holocaust survivor who built this multi-billion-dollar subprime empire from the shadows, running his company with an iron fist, all while his ads were claiming he was a proud sponsor of the American dream. Yeah, but behind those feel-good ads, the AmeriQuest playbook was just ruthless. They had these 228 loans with a low teaser rate that would suddenly spike after 2 years. They had huge prepayment penalties to trap borrowers in those loans. It was a boiler room sales culture with systematic fraud through inflated appraisals and falsified incomes. It was a business model built entirely on deception. So, the big question is, how did Wall Street sell this toxic fuel to otherwise conservative investors? Well, through more financial alchemy, of course. They took the absolute riskiest, lowest-rated mortgage slices, we're talking the stuff nobody wanted, and they bundled them into a brand new product called a collateralized debt obligation, or a CDO. And then they got the rating agencies to stamp a huge chunk of it as AAA safe. It was literally turning financial lead into gold. Which leads us to Section 4, no cops on the beat. So the machine was humming, right? Churning out billions and billions in profits. But a machine this powerful, this dangerous, really should have had someone watching it. So where were the regulators? Well, the hard truth is that the people in charge genuinely believed the machine could regulate itself. You know, the last real chance to get a handle on all this came way back in the late 1990s. There was one regulator, a woman named Brooksley Born, who saw the clear danger in this exploding, unregulated derivatives market, and she wanted to act. But she was fiercely shut down by the absolute titans of finance: Fed Chair Alan Greenspan, Treasury Secretary Robert Rubin, and Deputy Secretary Larry Summers. Their argument? Regulation would stifle innovation. And this quote from Alan Greenspan, wow, it just perfectly captures the entire dominant ideology of that era, that the market's own self-interest was the best regulator you could ask for. The whole idea of government intervention was seen as not just unnecessary, but actively harmful. And it's this exact belief that left the entire system with absolutely no safety net. But there were warnings. Inside the Federal Reserve itself, a governor named Ned Gramlich was becoming deeply alarmed. By the year 2000, he saw the predatory lending practices in the subprime market firsthand. He went to his boss, Alan Greenspan, and urged him to use the Fed's authority to stop it. And Greenspan, he just dismissed his concerns. Gramlich used this incredibly powerful metaphor to describe the situation.
He said it's like a city with a murder law but no cops on the beat. The laws against predatory lending might have existed on paper, but with zero enforcement, non-bank lenders like Ameriquest and New Century were basically operating in a regulatory black hole. Nobody had the authority or, frankly, the will to stop them.
And it gets even worse. Federal regulators actively blocked states from trying to pass their own consumer protection laws. They used this doctrine called preemption to just nullify local rules designed to stop these predatory lenders. What this did was create a safe harbor for bad behavior and ensured the machine could run at full, terrifying speed.
And that brings us, inevitably, to Section 5, the volcano erupts. By 2007, the machine just couldn't sustain itself anymore. The fuel was too toxic, the engine was completely overheating, and the pressure was building and building. The first tremors were finally being felt across the entire financial world. And the collapse happened incredibly fast. Check this out. February 2007, a top subprime lender, New Century, blows up. June, 2 massive hedge funds at Bear Stearns completely collapse. July, the rating agencies, the same ones who'd blessed this stuff for years, suddenly begin mass downgrades. And by August, a major French bank freezes its funds, basically saying, we have no idea what these American mortgage assets are even worth anymore. The whole system was seizing up. And right at the heart of this spectacular failure were the rating agencies. They had a fatal, built-in conflict of interest. I mean, their public role was to be impartial referees, right? But their business model, the issuer pays model, meant that the banks were paying them to rate their own products. So the competition wasn't for accuracy, it was for giving the most favorable rating to win the next deal. It was a complete race to the bottom. Now, AIG, the world's largest insurance company, was supposed to be the system's bedrock, the foundation. But a small, pretty obscure unit based in London had quietly sold tens of billions of dollars in these credit default swaps, becoming the ultimate insurance backstop for all of that mortgage debt. They thought it was free money because their complex models said a nationwide housing collapse was simply impossible.
But hidden deep in the fine print of those insurance contracts was a time bomb. It was a trigger that required AIG to post billions of dollars in cash collateral if their own credit rating dropped or if the value of the securities they insured started to fall. As a former trader at that unit later admitted, it was, quote, the stupidest thing we ever did. They didn't even seem to fully understand the risk they were taking on.
In August of 2007, that time bomb exploded. AIG got its first major collateral call. It was for $1.8 billion, and it came from a single firm that saw the whole crisis coming, Goldman Sachs. This was just the beginning of a cash drain that would ultimately bankrupt the company and force one of the biggest government bailouts in history. Which brings us full circle, right back to where we started, Merrill Lynch. In his obsessive drive to take on more risk and catch up to competitors, CEO Stan O'Neill had systematically pushed out anyone who challenged him, including his most experienced risk managers. He was flying the plane completely blind, with no idea that his traders had secretly kept $55 billion of toxic assets on the firm's books. And this was the ultimate disconnect, wasn't it? The CEO of one of the world's largest financial institutions had to be told by a sidelined mid-level employee that his entire empire was crumbling around him. That $6 million calculation from John Bright was the first dose of cold, hard reality Stan O'Neill had received in years. And by then, it was far too late. So, finally, we come to Section 6, why this story matters. Look, this isn't just some dusty financial history. The story from All the Devils Are Here is a timeless warning because the fundamental flaws in the system that created this crisis, they haven't disappeared. The devils are, in so many ways, still here with us. Just think about it for a second. The core issues are still here. The incentive to create and sell a loan without caring if it ever gets paid back, that's still incredibly powerful. Using complexity as a shield to hide risk, that happens every day. The problem of too big to fail is now bigger than ever. And the temptation to just outsource critical thinking to a computer model or a rating agency is as strong as it's ever been. So, in the end, this isn't just a story about Wall Street greed or regulatory failure. It's a much deeper story about human nature, about ambition, about ideology, and, maybe most importantly, about willful blindness. Understanding how this incredible machine was built and how it all came crashing down, that's not just some academic exercise. It is our single best defense against it happening all over again. Financial literacy, folks, isn't a chore. It's a tool for survival. And that's all for this deep dive. Thank you so much for joining me here on Book Talk Finance. To get more essential stories just like this one broken down and explained, make sure you subscribe for more discussions and talks. We'll see you next time.